One big one that just kind of rises to the top for me that I just see is that being a leader in the organization, growing a very successful organization, managing it through the ups and downs, because there's definitely more downs than there are ups.
One of the things is a lot of the delinquency, right? So according to TREP, right, Q1 2025, 10.5% of all office CMBS loans are delinquent, right? It's worse than the great financial crisis from 2007, 8, 9. All right. So, hey, Kevin, welcome to the show. Thanks for joining me today. What is going on at Sunrise Capital Investors?
Good to see you, buddy. Happy to be here. Lots going on, man. Lots going on. Hopefully the same with you. We're always staying busy, trying to find the next opportunity, working through, the day-to-day challenges. I'm running a private equity firm, and it's not all sunshine and rainbows. We have fun doing what we do.
Busy running the private equity fund. What is the latest? What is kind of an exciting project that you guys are working on? Or go ahead and we'll talk through some of the kind of day-to-day of running a private equity fund and what are some of the most important things to you. But what's some of the latest projects that you're working on right now?
There's always something unique. So our two verticals are mobile home parks and then parking investment. So, think parking lots, parking garages. We've been doing mobile home parks for 15 years now. So it's just kind of second nature to us. So always have something in the pipeline there. So, some more exciting than others, but we love the asset class, and we've done just about everything from heavy turnarounds, major lifts, new infrastructure, bringing new homes in to fill up the community, to buying more institutional grade, stabilized assets. The thing I'm probably most excited about, we've been diving into the parking space. It came on my radar probably about 7 years ago. It took me about 2.5 years of meeting everyone I could in the industry, going to conferences, association events, meeting vendors, just trying to, from the outside looking, it's a very simple business, but it's actually incredibly complicated. Dynamic pricing models, demand drivers, lots of variables of where the income's coming from. Is it going to stay there, right? And so we studied it for a couple of years before we finally pulled the trigger. So we actually didn't buy our first parking asset till late 2020. It would have been a little earlier than that, but COVID put a little delay on that. But bought the first one. And so I think what's most exciting is it's taken us a little bit of time to get some really good traction in the parking sector. And we've been able to buy one really solid parking asset each year for the last, basically the last 4 years. And then we've got some incredible deals under contract now. But what's exciting about it is, we closed out a deal at the end of last year, probably the most complex. And it's funny because I said this like 3 years ago, there was a deal we worked on. I said, it was the most complex deal I've ever worked on.
Right.
But I'm not a betting man, but if I was, I would have probably up until a month before, I would have said that there's maybe a 40% probability that this thing's going to actually make it to the closing table. So, but the excitement about that is it's in Charlotte, downtown Charlotte, across from the Spectrum Center where the Charlotte Hornets play. It's attached to the Bank of America, not attached like, below it, but, Skybridge to the Bank of America corporate headquarters. They use our parking. Truist is right next door. All these various demand drivers in the immediate vicinity, bunch of hotels. But the reason, the parking did great, we found it because, office, everyone knows office is just, it's in the crapper, right? It's having quite the struggle. The loan that was in default was one loan that encompassed an entire city block, had a hotel, had a big office, and had this parking garage, all underneath one parcel ID. And so the trick was it was in special servicing. Major tenant from the office had to leave there. And ultimately that through the whole thing, debt coverage ratio fell below the target and fell into special servicing. But the parking was the best piece of the whole pie. But we had to figure out how to actually get it cut out. And then, during special servicing, get it cut out, get a revised plat approved and filed with the city, and then literally bring two other, or another buyer or two other buyers to come buy the pieces that we didn't want, which was the hotel and the office. And we pulled it off, miraculous. We pulled it off. And that really taught us a ton. And it also opened our eyes to what I think is even bigger opportunities here over the next couple of years. There's lots of office assets that are in phenomenal markets, phenomenal locations. I don't want the office. I just want the parking component that goes along with the office that are in these prime locations. And so we've had a lot of conversation with all big office owners, big, institutional investors that are trying to find creative ways to lower their basis, to find their way through, a pathway through to get to the other side. So that's something I'm really excited about. I'm excited about the next 2 or 3 years, us being able to, kind of be the knight in shining armor and to help some of these groups, get out of default, get out of special servicing, lower their basis, help maybe make their investors maybe partially whole, where they might have lost all their capital otherwise. So I'm excited about that, man. So we got a couple of deals working right now that I can't actually talk about. One's like strict confidential, but
sure,
in phenomenal markets throughout the country, two major cities, and these are both parking deals. So I'm excited about parking, man. So that was a long way to answer your question, but like I'm super excited about the asset class. Long time coming. We spent so much time learning it and kind of mastering it, and now the timing just got right, man. Now we're ready to pounce.
Yeah, I love it. So there's a few things to peel back here. that I want to ask you about and just kind of ham and egg it and talk about for our listeners. But one of the things is a lot of the delinquency, right? So according to TREP, right, Q1 2025, 10.5% of all office CMBS loans are delinquent, right? It's worse than the great financial crisis from 2007, 8, 9. Banks, especially regional banks, are also sitting on about $600 billion worth of unrealized losses. And one of the kind of real viruses of the system, primarily in Cleveland, I primarily invest in my backyard. We primarily invest where nobody's building. So we buy a lot of B and C class value add apartment buildings, not in an area where there's a tremendous amount of other supply coming. So we can kind of control, when we do a value add, we can control the end product. And then we have one of the better products in the market. You've gone this route of mobile homes and parking. We went completely, just like you did, against the grain, did not invest in these kind of boom bust markets like the Sun Belt, like, you know, multifamily in the Sun Belt, or like office and retail in these kind of major metro markets. And now these major metro markets, the Sun Belt, are, we both know, like they're really starting to fracture. They're really starting to crumble in a lot of areas. I mean, office delinquency is huge. Office vacancy across the US is over 30%. So there's all this kind of stuff that's coming, and you've invested in things that are very recession proof, like mobile home parks and parking. We've invested in our own backyard in an area where we've been able to dramatically increase rents and control costs. So you've gone very much against the grain as we have. So, but although you've gone in a totally different route than we have, that's what I'm interested in talking about. So first of all, talk for a second for our audience a little bit more about the delinquency, the distress, the banks, the office, the retail stuff like malls, about some of that distress that you've seen looking at parking lots, and what is the stuff that's in special service that you're seeing out there? How much of it is there in the system that you've seen? How bad is it? And then secondly, how has investing in the parking lots that are maybe adjacent to those complexes, those other assets, how has that been the winning play?
Yeah. No, those are two great questions. I mean, I think you hit on a lot of the highlights of like the distress that's out in the marketplace, and the office thing. I mean, it was already kind of playing out before COVID. COVID was just like the nail in the coffin. You know what I mean? Office was already,
the word from home, dude, is the full word is the virus, right? That's what's making office sick.
Right. That's right. And again, there's a lot of companies. So the interesting thing, like there's been some companies that have like the one big shift. There's some major US corporations have like, you come back to the office or go find another job. Right. And so, so like that Charlotte did, Bank of America made everyone come back, I think, in the last 2 years. So everyone's there. They don't have no parking in their headquarters. Truist made that move like 8 or 9 months ago. And these are both their US headquarters, right? And so like the office is overflowing at those headquarters, but that's not the case across the country, especially more liberal markets where just if the headquarters is in California or, I'm not going to name specific names, but generally speaking, there's a lot of office, even high quality office stuff that's sitting there, 30, 40% occupied. There has been also, we start looking at cities like New York City and Philadelphia, major cities. Like there's been a flight to quality, so there's still demand for office, but the ones that are the office that's really winning is the brand new stuff, the stuff that's got, over the top amenities, it's the highest price per square foot in the marketplace.
Right.
But, basically whatever's remaining out there, companies now have some negotiating power when it comes to negotiating leases. Right. And so companies are like, well, we're in the office, we're staying. So now's the time. Like we got some leverage in the marketplace. Let's go negotiate a better office space, a better location for us, more room or whatever it might be. And they're all kind of, taking that flight to the highest quality. And that's kind of taking the stuff that was built maybe in the 2000s, 1990s, 1980s and all that, the B and C quality stuff. It's just sitting there and it's dying on the vine. And the challenge with that is that stuff costs a lot of money to maintain and to operate. And on top of that, the biggest challenge, I think, even on top of all that, is that whenever you do, in order to attract a tenant, if you're going to actually attract someone in there, you better be ready as an owner to be able to fork out a ton of TI dollars, tenant improvement dollars, in order to make a compelling reason why someone would actually move into your building rather than go to the nicer one that might be move-in ready, or, it's built in the last 5-10 years, right? Doesn't need a ton of improvements, lots of, upgrades to make it functional. So, it's been a long time coming, and now it's just, COVID I felt as though the work from home stuff like a nail in the coffin. But speaking to the parking stuff, so it's unique in that I would say that 90% of the parking we look at, so backing up a little bit, a lot of parking, at least in the urban areas that we're looking, we're in like central business districts, CBDs. A lot of the parking, a lot of it was really built. If it was built back in the 70s, 80s, 90s, it was probably built to have to be a major support mechanism for an office or multiple office buildings, right? So, and while it will have other demand drivers, there might be, folks that come just to that downtown area, to an office, eat or whatever. It might have other variety of the demand drivers, but a lot of the stuff we look at, while it's a great location, I like to call it irreplaceable real estate. If it's in a great city and that footprint is irreplaceable, they're not making more of it, right? However, I don't know how to fix the office problem. So if the main demand driver of the revenue was coming from an office or multiple offices that was in that marketplace, it's a great location, I don't know how to ever bring that back again. Because that would mean I'm a miracle maker and I know how to fix the office debacle, right? So 90% of the stuff we look at comes across our desk, and it's a great city, great location, great. We could pick it up at a great basis. I can fix that big problem. And so for us, in order for it to check all the boxes, it's got to have a fairly significant variety of demand drivers. So sports arenas, music venues, government, hotels that need, most hotels in the CBDs don't have parking, or if they do, it's limited. So they need to kind of leverage other parking garages for their valet and all that. Office can be one of them, but it's got to be the smallest of the batch, right? And so I need to know that there's enough other variety and other things I know just aren't going to go away. They're not going to disappear. And if something did happen to one of them, I'd have 4 others to support the revenue and demand. And so for that reason, a lot of the stuff we look at, I don't even know how many parking deals we looked at last year to find that one in Charlotte that truly did check all the boxes. And lastly, the last thing I'd like to speak to, and this isn't all the time, but for us, for parking to make sense, a lot of parking you'll see that is associated with office buildings is probably, it was built below, it's integrated with the office, right? And the office is above. And there's ways to get around that. There's ways to condoize those things out and kind of, have a separate deed for the garage. But the challenge is I don't control the future then. Like I can't say that in 20 years that the demand, if the highest and best use for that garage is not parking, I can't just, make the vote to tear the whole damn thing down. Let's build something else, right? Because someone else is going to own the office above me. And so again, ideally for us, it's got to be a standalone. It might be associated with something else, but it's got to be proven to be a standalone. Like the one in Charlotte, it's a standalone. It is attached by a sky bridge to the Bank of America's headquarters, but it's on its own parcel ID. We can knock that thing down tomorrow if we want. We're not, but we could, and build, 80 feet or so.
What I like about it is you've taken an asset that a lot of people don't think about that's got almost no CapEx, right? Very little staffing requirement, especially when things are automated, especially in downtown markets with a variety of demand, including, like you mentioned, hotels, concerts, the smallest of them being offices, events, things like that, and found an asset class that few other people really discuss on podcasts or discuss as far as an asset class. And frankly, it's a lot like mobile home parks or like trailer parks, right, where you have the asset, which is the land. And people come in with, in this case, could be a trailer park, or they have an RV that they're bringing in or a mobile home that they bring in. And that's essentially chattel. It's basically part-time, and they rent a space and they rent it for, in case of a mobile home, maybe a long, long time. It could have an RV park. It could be for the season, but again, low CapEx requirement, very low, tiny CapEx requirements. My business is really the opposite. We're buying a lot of C and B class stuff that was built in the 60s, 70s, 80s, 90s, buying in this first and second tier of suburbs where there's no new construction. And then we're renovating that stuff to bring it up so it looks like new construction, looks like it's new. It's a lot of CapEx, but we're also forcing the value up a lot. So you've gone a little bit different route than I have because your CapEx requirements are pretty low. So help me understand a little bit about the parking mechanics, the financials. Like, what are some things that you underwrite to? What are some of the key financial or the KPIs that are important when looking at a parking lot from a private equity perspective? Like, how do you present that or sell that to a group of investors, right? What attracts an investor into a private equity structure or a single purpose structure where they would be investing into a parking lot? I think that's a totally new concept for a lot of folks.
Yeah, and just to give some clarity on our structure, how we do things, we do not do single asset investments. We have, this is our fourth fund. We'll be rolling on the fifth one here at the end of this year. But our current fund,
funds every year?
Yeah, SEI, typically every 2 years. SEI Growth and Income Fund 4 is what we have now. And this fund and our last fund was a blend of both mobile home parks and parking. So we have a blend of the two assets in there.
Nice.
And so we do some, just as the name would indicate, growth and income. I mean, we'll buy some, the parking stuff we buy, it very much is stable with upside is the best way to put it. It's cash flowing from day one. We're looking for a yield on cost by the end of year one of 8%, and then some opportunity to have runway from thereafter. And so that's very much the income, and it's pretty steady eddy over time. And so, most of the markets we're in also have it's very much an inelastic demand. Like there's parking shortages. In fact, most of the major cities across the country within the last decade have removed the parking minimum requirements from developers. And why that's important is that, historically what would have happened, you or I would go down, we try to, present a plan to get approval. We want to build a high rise, multifamily office, whatever it is. The city would say, okay, yeah, sounds good. We'll approve you. You need to put in X number of parking spaces per every 1,000 square feet. They have some type of formula that, that is just, they pulled out of thin air that, has no relevance whatever to probably the project itself, but the developer order to do it. They still had to actually put that amount of parking. What that actually created a lot of surplus for many, many decades of parking in downtown areas. Well, that was removed, many, many years back in most cities. Some cities removed it 20 years ago. And so what that's allowed for is developers now they're like, well, shit, I only need, maybe a, 0.4 spaces per every 1,000 square, whatever it is, right? And so they're building just enough, if not even enough, right? Because they make more money on putting another condo unit, another multi-family unit than they will parking spaces that are just going to sit there empty. And so that's created the shrinking supply for this parking stuff. And so in any event, it's pretty neat because, the demand will be there, inevitably for many, many years to come, the stuff we're buying. And then when it's no longer there, right? And whenever cars are flying or we're, holding onto a drone and get dropped off,
Right.
I'm not even like, I kind of joke about that, but like obviously the technology, like inevitably at some point in time, the transportation landscape as we know it will look very different. It already does. We look back 15 years, right? Like who would have thought you get on the highway and like literally take your hands off the wheels and let a car drive you 80 miles an hour with a bunch of people in it, right? And get there safely.
Automated taxis in Phoenix. Like things are starting to change. So it's going to take a long time. Like you're going to get rid of a parking lot to build some other like that's rough space. It's going to be like, okay, we got this infill piece of land.
And you can't build these anymore. Like you can't even actually, you can't, everything that we're buying, literally, you would not be able to rebuild. So everything we've bought parking structure wise, we're buying it below replacement cost. You would not be able to rebuild any of the stuff that we've acquired. Even if you were allowed to, you wouldn't be able to rebuild the stuff we've acquired. So again, in our eyes, it's an incredibly safe play. And then lastly, we really put an emphasis on the underlying lot, the value. What is the value of that lot in that marketplace? And we're not developers and we don't underwrite the future value as it relates to, what could go there and what would that be worth? But we know that there's that option. And it's a huge one, right? Like the higher and best use at some point in time. Right now, the lowest use that piece of land could ever have is what it is at present time. And it's
right.
Yeah, that's it. Like it's literally its lowest form.
Buy that and I'm going to put up a hotel. Or I'm
absolutely.
Buy that.
It's in its lowest form right now. That means it can only go up from there, right? It's funny. I joked about the when we bought the Charlotte garage. Charlotte Hornets did not have a great season, right? So I was like, it can only go up from there. People still come to the games. They attend the games. They haven't done it well, but it's only going to get better from there.
But the Hornets were terrible the entire time that Jordan owned them.
Yeah,
they were terrible for 10 straight years. I don't know if
isn't that fun?
He made like 100x investment or no, I think he bought.
He's still he actually still has a sliver. He sold the majority.
$3 billion.
Sliver. Yeah,
10x. And it still owns a sliver, and it's still terrible. They're just still bad.
Yeah, so I mean, we literally made the joke. It's just I'm being serious though. They just re-signed their lease. The Hornets just re-signed their lease on that garage. I think for another, I think it was 22 years. And they're literally right now during off season. They started I think it's a $300 million renovation project at Spectrum Center. They're doing half during this off season and then half the next off season. So they're not going anywhere anytime soon, right? So again, they're about as bad as it gets. And they still attract a lot of folks to that arena as well as, music events and all that kind of stuff are there. But I'm back to the, I was mentioning like kind of how we do things, not deal specific. It's a growth and income fund. Parking is very much income. And then the growth side typically comes from the mobile home parks. And everything we do has got some type of value add component, but I'd say the mobile home parks definitely have quite a bit more of a value add component to them than the parking typically does. And so it blends really, really well together. It allows us to do more stable.
Well, what are the
And then
typical CapEx opportunities on a mobile home park that creates the upside? Like, what are some typical amenities you can add, things like that?
yeah, it's not necessarily around amenities per se. You know, we have some communities that have zero amenities. You know, it's just very much it's workforce housing, and in order for us to keep it incredibly affordable and the best affordable housing in the marketplace, like to put in playgrounds or clubhouses, things that might look good on marketing material. Like we just know that that's not necessarily why the people are living. They're living there because they want good, safe, affordable housing in a good school district, but don't necessarily want to pay for all the frills that might come along with a higher price point. And so, but then on the flip side of that, we have other communities that have pickleball. We put pickleball courts in, right? We kind of we go resident base, like we survey them, how many kids are in the community, general age of kids, and what's that?
Said tennis elbow I got.
Oh, that's funny. That's where it's on it.
That's what it's from.
It's funny. A crazy sport. I was having a fun conversation the other day with some friends about it. I was like, pickleball is literally what racquetball was in the 80s. Racquetball had like this decade run. They started building them in gyms and all this. So now, I don't know anyone plays racquetball nowadays, but
everyone wants to play outside, man. Pickleball is a sport. I got my kid. I got a 13-year-old, a 15-year-old, 16-year-old, all signed up for summer pickleball, like
that's all
clinics and classes and stuff like that. So, but back to your mobile home parks, you adopt amenities. So what's the value add trade there? Is it adding?
So, I mean, we'll go in and
some things.
A lot of stuff that we buy, I would say it might not be from we buy a lot of things from the original owners. These things are 40, 50 years old. And then if it's not from the original owner, maybe the person we're buying it from just they haven't put the money back into it, right? They've just been, kind of peeling out all the cash flows and never putting anything back in. And as you know, over time, roads get potholes.
Yeah.
Electrical pedestals need replaced. Just curbs crumble and need to be replaced. I mean, just all these various things break down. Water lines need to be replaced. Sewer lines need to be replaced. And so we'll go in and basically breathe new life into it. And I'd say the big ones are, new roads, like it's amazing just the difference in a community. If you literally just went in and repaved the entire community, literally ground up everything that was there and truly laid a new, 3, 4, 5-inch layer of asphalt throughout that entire community of the just overall improvement of aesthetics that it gives. And then driving experience too, right? Not hitting potholes and bending your rim every time. So that's a big one. We'll go in and put, signage all throughout. We'll make it nice and attractive with signage. We'll enforce rules, like a lot of times we'll take over a community where they didn't enforce rules. And what happens is, and if they're not enforcing general rules of like, making sure that your home doesn't have mold growing on the side of it, got 8 cars parked in the driveway, you don't have a bunch of shit in your yard, right? All that kind of stuff. We go in and just create some organization within the community. Because ultimately, when you allow that to happen, you start attracting the wrong element to the community as well. Like if you're comfortable living next to Sanford and Son, you know what I mean? Like,
yeah,
like that's not good, right? Like becomes a virus throughout the entire community. So we just go in and create some uniformity, create uniformity, really start supporting those that really want to live there and want a clean, safe, and quiet place to be, and get rid of all the rest. To your point of like bringing homes in, like one big project we're working on right now, it's probably a good example. It's in a phenomenal market in North Carolina. It's literally 10 minutes outside of downtown Greensboro, which is the 3rd largest city in North Carolina. And this park, this is right down the fairway for us. I've been working on this thing for like 9 years, talking to this guy, pain in the ass owner. He bought it, I think like 11 years ago. Lives in Boston and never had a plan. He bought it. He's a real estate investor. He's got stuff up in Boston. I don't know. He never really had a plan though. It's 198 spaces. And over time, he never put money into it. Just literally, he didn't fix any units. It didn't enforce rules. I mean, literally this place, I don't even know the last time he visited. I mean, years and years. And when we finally bought it from him last July, only 55 of the lots were now vacant, because what also can happen, you take your eye off the prize. Not only do people maybe move their homes, but if they move out of your community because you're not taking care of it, maybe they're moving their home. But guess what? Some other investor in the marketplace is going to see that home and go buy it for $5,000, $10,000. They're going to move it out and move it somewhere else so they can make money with it, right? So that's ultimately that happened over a decade. He literally lost over 100 units inside that community. Absolutely insanity. And he did buy it on a low enough basis where he was still almost breaking even. Even with like 40. And so he never had the motivation, right? His money slowly dwindled over time. And then only until he literally was busy at a break even did he decide to sell. But over those years, he didn't do shit. He didn't even keep the grass cut in the areas where the homes moved out. So he had like this massive 40-acre piece of property. It just looked like a jungle in most areas. It looked like no one lived there, but people did. And so we went in and we're now, we're less than a year into it, but we've already brought in 50 brand new homes. There was about 20 homes that were just abandoned beyond repair. We just ripped them out of there, redoing roads, redoing the parking pads, putting a really large playground in there, build a brand new office, putting street lights throughout the entire community. It's like pitch black. And like you drive in there, it's like, I can't even see the road in front of me, right? Like it was interesting. So anyway, we're breathing new life into it, putting a lot of money into the infrastructure and bringing brand new homes into it so that folks that want to live 10 minutes outside of downtown, but still have a brand new home, but have it be more affordable than anything else in the marketplace. That's how we're adding value there. I think we bought it for $3.5 million. And I think our total investment of new homes and infrastructure over the next couple of years is roughly, it's like 6 million, give or take 6.5 million. And I think our pro formas don't mean shit, right? But anyway, I think probably be somewhere in like the 14 million range when we're all said and done. And we should wrap it up in like it'll probably take like another 2 years to get the homes in, get them set, but get them absorbed into the marketplace, get some stability in there. Yeah. So it'll be a good project in the long run. The neighbor, the surrounding neighbors are super happy with it. The mayor's super happy with it. Everyone's happy with it, right?
Nice.
So that's rewarding too. I like that piece of it. You know what I mean? Like kind of the before and after, doing something good, doing well financially by doing good socially. It's a great thing.
That's important for sure. Especially with workforce housing, people can afford. That's a big problem in our society right now.
Yep.
One of the things that I've noticed about so many other real estate operators and sponsors who are now in default, right? Who are really struggling is they bought properties not locally. They bought properties like guys live in Dallas, they bought properties in Cleveland, or they live in Chicago and they're buying in Orlando, and they're not local. They're not around their assets enough. And they were waiting for the market to drive their success, population growth, income growth, all this was going to happen. And then what happened was they got caught where, interest rates went up, insurance costs went up, and there was new supply built.
Yeah.
So they didn't get any rent growth. And then now their value hasn't gone up. And because interest rates are up, their values actually come down, and now they're hurting. And on top of that, they invested virtually in other markets.
Yeah.
So I'd love to hear your comments on that and just what your take is on guys that invested that way. And also what I'd like to hear more about is you've gone really the exact opposite. Like your stuff, you might be investing in other markets outside of where you live, but you invested in things like parking lots, mobile homes, things that don't require a lot of CapEx. And how are you managing the local operation virtually when you have assets in different places? But you bought some things I've already noticed that don't require tons and tons of property management or tons and tons of heavy value add CapEx. That's one way that you've already mitigated that risk, where other guys got totally hammered by that over the last 5 years. So maybe just your thoughts on the strategy that you've deployed in order to mitigate some of this contractor risk, property management risk when you're buying things in multiple markets.
And I just want to clarify something. Actually, there is quite a bit of, probably more in parking than in mobile home parks, and as far as like ongoing CapEx and just what we do in the front end, but then what's ongoing thereafter. Say with the management, some of our communities, we don't own any of the homes in them. The mobile home parks, residents pay lot rent, they pay on time. Others, it's a different demographic. We might work a little harder to get that monthly payment. We might actually own some of the mobile homes in there, which turns it into a rental unit, which is much more upkeep and maintenance and turnovers and all that stuff. So I don't want to put the wrong idea out there to folks that are maybe thinking about that as an asset class. I think that it's kind of a set it and forget it, because it's absolutely not. It's in fact far from that. So,
and then I would say nothing is set it and forget it.
Yeah, no. Well, garage is kind of the same thing. It depends on what part of the country you're in. Like, I could take the same asset that is in Charlotte and put that up in New York, right? And then you got snow, you got salt, you got all these things. And, if you have an asset that hadn't been maintained or concrete waterproofed on an ongoing basis, you get salt that trickles its way down to the infrastructure and the rebar and, creates structural issues. And so our CapEx budget actually is pretty high on most of the garages we buy. We just underwrote this one in Philly that we're working on. And I think our initial going in CapEx budget on it, it's like a $25 million deal. And I think our initial is like 1.16 on like kind of immediate items, and then we run out over 10 years. It's about $300,000 a year over the next 10 years.
Okay.
Yeah, but like it's in an environment. It was built in the 80s, so not super old, but I mean, you get salt on the roads. I mean, it's a lot of heavy traffic, lots of in and out. But then even like the management of those things, you got to think these things were built before automation was a thing, and so automation only takes you so far if it wasn't designed around the automation. So a lot of the garages we have, while we might have automated arms and payment options, we still have staffing there because automation doesn't always work, and you need to go get people in and out, right? Get it easy. You let them in and out easily, not be stuck in a backlog.
Nothing worse than you're about to leave your garage and then you can't pay.
Yeah,
the guy in front of you can't pay and you're stuck.
It's absolutely horrible. So we have staffing, and so there's staffing expense and payroll and all that kind of stuff. But anyway, so I just wanted to create some clarity there. Now, parking lots are different. If you just have a surface parking lot that's asphalt, there's literally not much to do there as far as CapEx other than fix a pothole or maybe put some new stripes in there once in a while. But in any event, as far as I think, you use an example of the multifamily, some of these guys getting hurt. And I don't know if that is so much as them being maybe out of market or where the property was. I think there's a lot of I think that could be potentially part of it. But I think there's a couple other, ingredients there that really led to some of these downfalls. I mean, number one, it became a very risky business model when you're leveraging really high with bridge debt. There was never a plan B if the rents didn't continue to see significant growth and the values didn't see significant growth. There was not a plan B for most of those going in with a bridge debt with a 2 or 3 year plan.
Right.
If rates went up a little bit, or if rents stopped climbing at a pace that they were, because they're leveraging these things for 80%, 85%. I mean, like
there's rent growth.
There's no plan B, and so I think that paired with multifamily is just a different animal than mobile home parks. There's new supply coming out all the time. On top of that, you're basically, I'll use like a Dallas or a Houston. You're going up against some incredibly sophisticated operators, some that actually have the wherewithal to maybe carry some of these projects through, or maybe have the wherewithal, if there's a little bit of oversupply in the marketplace, they can temporarily cut their rates to make sure that they get occupancy up, right? Whereas that's going to have a negative effect on you, right? Like, I think it's just much more hyper competitive than the space we're in. Like, they're mobile home parks, there's literally no new supply coming to the marketplace. And so if we're in a great market in a great location, and we can provide a great product, like, I don't have to worry about another mobile home park being built right down the road, or, the other mobile home parks in the marketplace. Because if it's a good market, more likely they probably already have high occupancy. Like, we're kind of picking the one-offs, needles and haystacks that just haven't been maintained, haven't been kept up. But we know that if we bring in the right product in there and clean it up and make it look great, that the people will come. And there's plenty of people that will absolutely come. And so, I think folks got out in front of their skis, of not thinking about like what's worst case scenario, like if rates will go up, or if this business plan needs to make a little bit of a pivot or a shift, like how do I get out of this? How do I make my investors whole? I just don't think that it was kind of rising tide lifts all boats, and that tide was going up for so long that people got stuck in that illusion that it was just going to continue in that path. That's it. And everyone got called their pants down, and it sucked. Because even some really, I think, sophisticated folks just found themselves in a unfortunate scenario, right? That just, and hopefully they had the financial wherewithal and the pockets to carry them through or manage their way through. But
we're still going to find out over the next couple of years.
Well, yeah, right. And I think one last thing I'll make note of here is, I think this is something when you're talking to, if you're an LP out there looking for some investments, passive investments, is really understanding the financial strength of the primary sponsor that's running or sponsors, right? Like what are their personal balance sheets? Like what do they have the wherewithal? And not that, that's the necessary path if there's like a financial shortage, right? Like, typically it's gonna be a capital call from all parties, but like, where are they at financially? Are they going to be able to actually inject their own did they just do this for the acquisition fee, right? And got a big, $1 million pop in their pocket? Like, outside of that, they literally don't have a pot to piss in, you know what I mean? Like, so like, make sure that you got some financial stability on the sponsorship side that can hopefully carry this. So I'll give you an example. I'm invested in a medical office fund. It's a close buddy of mine. He's one of the partners, but he's a third generation family. Like, they've been in the commercial real estate space, actually up in, not in your neck of the woods, but outside of Columbus. And they invest all through Florida, Ohio. If I named it, you'd probably know because they're all over the place in Ohio. Sure. But the main patriarch that started, he's like 88 years old, still literally going into office every day. That family has incredibly deep pockets, and they've brought money in from, family offices, high net worth individuals like ourselves, all across the board, right? I know for a fact that if something did go sideways, if one of the deals just didn't pan out, they sure as hell wouldn't do a capital. I know they wouldn't. I just know, I know from a pride standpoint, from a reputation standpoint, they would suck it up to like, this is no fault of my investors. We're gonna make this whole, this shit happens, right? You get a deal every once in a while that just doesn't pan out, and they would make it whole. It hasn't happened, but I just know that they had the wherewithal to do so. And I'm not saying that your sponsors have to be billionaires, right? But like, it gives you some comfort to know that they've got the ability to kind of chip in and help if things do start going sideways, right? So
yeah, no, I love it.
And I just don't think that was the case. I don't think that was the case with a lot of the folks kind of hopping into the space.
Yeah, a lot of guys that were in Resi that went to a seminar, saw the low cost of debt, decided to jump in. You got like all of a sudden 6 partners buying one deal.
Yeah.
Their first deal ever. That's a $25 million property. It's like, what are you guys doing?
And I also subscribe to the fact, and again, this is just me, and this is just how I've always kind of done things. I think I really subscribe to the fact that before you go raising capital from outside parties, I think you need to risk your own capital. Maybe you can't risk on a $25 million deal, but do it on a 4-unit property, do it on an 8-unit. Literally, you run the same business plan, but risk your own capital before you bring it from somebody else, and prove the concept, prove the business model. Truly say I got a little bit of, like, I've done this, and I've got some capital that I'm willing to put it on the line, because honestly, like a lot of LPs, to meet the minimum accreditation status, it really doesn't. They haven't changed that law for how long? It's been a long time. Like, to have $1 million net worth surely does not mean you're a sophisticated investor. And so a lot of these folks, they've worked the last 20 years to save up a few $100,000 to go put in these LP investments. They really are putting it all on the line, right? Like this is the difference of them retiring maybe in 10 years and maybe having to work for another 10 years thereafter. So
love it.
Anyway.
So Kevin, last question, really more around entrepreneurship, I guess, instead of, asset classes and real estate, interest rates and cap rates and occupancy and things, but building a business, as you and I both know, whether that business is around mobile home parks, parking lots, e-commerce, real estate, manufacturing, is an absolute bitch. It just is. Building a company, although it can be exhilarating and fun, is a lot of hard work. In your opinion, based on your own experience and entrepreneurs that you've been around, what are some traits of elite entrepreneurs? What are some traits of the guys and the gals that have really built amazing companies? What are some things that you think you see maybe in yourself or in your firm, but also other people that you've talked to? You've interviewed obviously hundreds and hundreds of people for your podcast. What are some regular traits that you see in the elite operators, the elite entrepreneurs that have started with nothing and grown amazing businesses?
Yeah, there's 2 that come to mind, and we had some conversation with some of our team members the other night, and one big one that just kind of rises to the top for me that I just see is that being able to being a leader in the organization, growing a very successful organization, managing it through the ups and downs, because there's definitely more downs than there are ups, right? Is be able to be comfortable in very uncomfortable situations and maintain mental clarity during those times when the average person would literally crumble and wouldn't be able to think about anything else other than what's going wrong, other than what are the 3 ways to get us out of this? And then, ultimately, let's continue thinking about the future. Forget about the present day. What happened has happened, and let's figure out a solution and move on, right? And so I think that's a big one. Just be able to truly be comfortable in incredibly uncomfortable situations, whether it's financial, whether it's negotiations, whether it's anything whatsoever. And I think that the next one is having an attractive personality and being one that can inspire and motivate those that are your employees, your team members. There's a clear delineation between, successful leaders and just, employees, right? Employees, they might have the elements, they might have the ingredients. They need the coach, right? They need the coach to be able to actually pull it out of them to help them shine. And I've seen many occasions where, we've actually hired somebody from another organization that has been, they're fumbling, struggling a little bit. We actually made some great hires over this past couple of years when others were kind of struggling. These are some of the best hires that we've made. And these folks weren't able to shine. They weren't able to shine. They weren't able to show their best in this other organization because the leadership was failing miserably. However, they've literally, they've stepped up the ladder on multiple occasions within our organization in a short period of time. So I think just leadership, being a great leader, study leadership, study other successful business owners, coaches. Those are the 2 big things that really pop out. Outside of that, I think health and fitness, that doesn't always ring true. Surely we probably know some business owners that aren't in the best, shape, right? But I would say more often than not, health and fitness, diet, really focusing on you. It seems as though that holds a very high importance to some of the, leaders of the largest companies in the country. So president probably doesn't fit in that camp, unfortunately. And Warren Buffett doesn't either. I think he still drinks like a soda and eats McDonald's like 5 days a week, which is incredible that he's lived as long as he had. But same with Trump. I don't know what the hell he eats, but obviously it's probably not vegetables and lean meats.
Yeah, that's right. That's right.
So,
well, look, I mean, being able to, like you mentioned, basically withstand stress, stay comfortable in uncomfortable situations. And ultimately, I think that's why entrepreneurship and entrepreneurs that are successful do make a lot of money, because you're getting paid to either create a product that the market needs and needs a lot of. But in addition, you're also getting paid to make incredibly difficult decisions that the average person would totally crack under, not be able to make those decisions, not be able to comprehend all the moving parts and make a valuable decision that pushes the company forward. So in order to then make those decisions, you have to be in great physical condition. So you're in great mental clarity to be able to withstand all the pressure and all the stress that guys like you and I and other successful entrepreneurs are put under. I think it's all intertwined.
Yeah, you do incredibly well successfully because you've managed how to solve complex real estate problems, right? I mean, like in your own business, in your niche. I mean, that's why you have risen to the top. I mean, like you figured out how to find a pathway through when others have just saw a door. You figured out how to open the damn door up, right? And probably open more doors there after that. But no, I agree with you, buddy. No, that's fantastic. Great way to summarize that.
Awesome stuff, Kevin. Listen, thanks for carving out some time for the Accelerated Investor podcast today and telling us your story. Tell our audience a little bit more about where they can catch you, whether they're interested in looking at your deals as a limited partner, getting your book, things like that. Where can they find you online?
Yeah, so if you want to learn about what we're doing at Sunrise, you can go to investwithsunrise.com. We've got, our current offerings up there. We've got some webinars. We even go as far as we put case studies up there on deals we've gone full cycle with. We share business plans of existing deals that are in the portfolio. So we provide quite a bit of information there of just who we are, what we do, and how we do it. Outside of that, I can say my last name's so unique that if you just go to LinkedIn, I'm pretty active there, Instagram or Facebook, and just type in Kevin Bupp, I'm pretty sure I'm the first one that will pop up. So you can find me any of those places.
Awesome, man. Appreciate Kevin. Thanks so much for jumping on today.
Thanks for having me, Josh. Appreciate it.